Level 1. Negative balance. Your account is in the red. Maybe by $11. Maybe by $340. The number almost doesn't matter, because the system that responds to it doesn't scale with the severity. It simply activates. The Dishonour fee lands within hours. Between $10 and $15 at most Australian institutions. Some charge it per transaction. If your account is negative and 3 direct debits attempt to process overnight, a streaming subscription, a gym you forgot to cancel, a phone plan you've had since you were 19, you wake up to $45 in fees on top of the deficit you were already carrying. The math of this is almost elegant in how precisely it punishes the wrong person. If you had the money, you wouldn't be overdrawn. But because you don't have the money, you now have less of it. You open your banking app at 7 a.m. before work. You already know what you'll see. You open it anyway because not looking feels worse. The balance is negative. There's a small red indicator next to the account name. The app is clean and well designed and entirely indifferent to the fact that you have $4.60 in a separate account and $210 in a payment that cleared last night from your employer, and the timing of these things is the entire problem. The system doesn't know about the timing. The system knows your balance is negative and the fee has already been assessed. You try to tap and pay at the servo on the way in. Your card declines. You try again. It declines again. The person behind you is waiting. You switch to the other card and you're doing mental arithmetic about whether you have enough there, but you do, barely, and the transaction goes through and you drive away and you feel the specific and familiar version of shame that is not dramatic and not cinematic but is just this: a card declining at a servo at 7 a.m. when you're already late and you haven't had coffee yet. This is what financial stress actually feels like. Not dramatic. Not a scene. Just a card declining and arithmetic you can't finish fast enough and everyone behind you watching. The bank offers you an overdraft facility. What this means in practice is that instead of declining the transaction, the bank will cover it and charge you a fee for the service of not embarrassing you at the servo. Some of the neo-banks have eliminated these fees entirely. Most of the major institutions haven't. The ones that remain are disproportionately paid by the accounts that can least afford them. You cannot get a credit card here. You cannot get a personal loan. You cannot get patience or flexibility or a phone call from someone who wants to understand your situation. What you get is automated. A fee assessed by a system that does not know your name, does not know that your pay was delayed 2 business days because of a public holiday, and does not know that your account would have been fine yesterday if the timing had been different by 24 hours if you are on Centrelink. The system at this level has a specific relationship with the fortnightly payment cycle. The gap fortnight, the period every 6 months where a fortnightly payment doesn't land, is not flagged in any bank system as a known cyclical event. It is processed the same way a missed payment would be processed. The account drops. The fee activates. The person who has been managing perfectly has one anomalous fortnight and is charged for it. The system knows one thing about you. Your balance is negative. Everything else follows from that. You are not a customer at this level. You are a cost the bank is managing, level 2. Low balance. You've pulled it back from the negative. You have $300. Sometimes $500. On a good fortnight, $800. Before the rent processes and it drops again, you are not overdrawn. You are something slightly better than overdrawn, which is to say you are in the category of accounts the bank services but does not particularly value. The monthly account keeping fee arrives. $8. Sometimes $12. Automatically. Debited because your average daily balance did not meet the minimum threshold required to waive it. The threshold is usually $2,000. Sometimes $500, depending on the institution. If you had $2,000 sitting in the account, the fee would disappear. Because you don't, it stays. You are paying to hold your own money in an account that was supposed to be free. The savings account, if you have one, is earning 0.01% annually on whatever sits there, which is approximately nothing. Meanwhile, the bank is lending your deposits out at rates between 7 and 22% depending on the product. This spread is how banking works at every level. At this level, the gap between what they pay you and what they earn from your balance is simply something you fund without a say in. You apply for a credit card. You might get approved for a low-limit card, $500 or $1,000, with an interest rate of around 20%. Or you get declined and offered a secured card instead, which requires you to deposit your own money as collateral against your own credit limit. You are, in other words, lending the bank your money so they can lend it back to you and charge you interest on it. This is legal. This is normal. This is how credit history gets built when you are starting at the bottom of the system. There is a version of this level that is particularly common in regional Australia. The branch that used to be nearby closed 3 years ago. The ATM that was free to use was removed. You are banking digitally now because there is no alternative. When the app is down, which it occasionally is, you have no recourse. When you need something that can't be done through a screen, a bank check, a certified document, a complex transaction, you drive to the nearest branch town and take half a day to do it. The bank doesn't measure that cost. It doesn't appear in any fee statement. It is invisible to the institution and visible only to you. The service you receive is not hostile. It is indifferent. The teller is polite. The app works fine. If you call about a problem, you wait on hold for 15 minutes and eventually speak to someone in a call center who is reading from a decision tree and can solve standard problems and escalate non-standard ones to someone you will never speak to directly. There is no relationship here. There is a transaction. You need basic banking services and they provide them. That is the complete extent of it. You are a number at this level. A small number. And the bank's interest in small numbers is entirely automated. Level 3. Stable income, something changes, but not dramatically. You get a job that pays consistently. Or the job you had starts paying better. Your payroll hits every fortnight like clockwork. $3,400, $3,800, regular. The bank notices. Not with a phone call. Not with congratulations. Algorithmically. The pattern of your account shifts from irregular and low to consistent and moderate, and the system responds by placing you in a different behavior category. The credit card offers start arriving. Not the secured card. Actual cards with actual limits. $3,000, sometimes $5,000. The rates are still high, around 19 to 24%, because your credit history is short. But the door is open now. The institution that had nothing to offer you 3 months ago is now sending emails and displaying banners inside the app. You have become a viable revenue source, and the product suite has unlocked accordingly. You apply for a small personal loan. $10,000, maybe, for a car. It's approved within 48 hours. The rate is around 9 to 11%, which is not ideal, but it is functional. What you notice is that the process worked. You needed something, you applied, the application was assessed, and you were approved. For the first time, the bank functioned the way banks are supposed to function in the stories people tell about banks. The account keeping fees are probably gone now, because your regular payroll credits trigger the waiver condition. This is a small change that feels larger than the amount, because you are paying those fees for long enough that their absence registers. The HECS debt still shows on your credit file. Some lenders count it in their serviceability calculations. The bank processing your home loan application will. That is a fact most people discover during the application, not before it. And if your balance history has had volatile periods, months where the account was low, followed by months where it recovered, that pattern is visible to the lender's risk model. The story your account tells about your relationship with money is being read whether or not you know the language it's written in. You are a customer now. Recognized. Serviceable. The bank wants to retain you because you are generating revenue through card interchange, loan interest, and a balance they are lending out at a spread. You matter to them the way a customer matters to a business, which is to say, you matter as long as you are spending, and you would be replaced without ceremony if you left for another institution, level 4. Growing savings, you have been consistent. Not lucky. Not dramatic. Just consistent over ordinary years. The savings account has $22,000. The offset account on your home loan, if you've reached that point, has another 15. The credit card is paid off in full every month, so the 20% interest rate is irrelevant because you never carry a balance. You have built, through the ordinary accumulation of ordinary decisions, a financial profile that looks meaningfully different to the bank's risk models than it did 4 years ago. The credit limit increases start happening without you requesting them. You log in and the limit has moved from 4,000 to 9,000, then to 14. The bank is extending you more capacity because your history demonstrates you don't need it. You pay on time. You don't reach the limit. You are a low-risk, high-engagement customer, and the system responds to that by offering more of what you've proven you can manage. The loan rates improve. When you refinance your home loan or take out a car loan, the rate is meaningfully better than what you were offered 3 years ago. Not because they like you more as a person, but because your credit profile and asset position have changed the risk calculation in your favor. The price of borrowing money is lower for you now because you have demonstrated that lending you money is safe. This is how wealth compounds through the banking system even before the wealth itself is large. Lower rates mean less money leaving your hands on the same purchases. Less money leaving means more capital accumulating. More capital accumulating builds faster than less does. The system begins tilting slowly and quietly in your favor at the level of basis points and approval conditions. There is another change at this level that is less visible but equally meaningful. The way credit bureau data is interpreted shifts. When you were at level 2, any missed payment or credit enquiry sat heavily against a thin file. Now, your file has depth, years of on-time payments, a closed personal loan that shows full repayment, a credit card that is used regularly and cleared monthly. The same credit event that would have damaged you severely at level 2 causes much less damage now, because it is evaluated against a longer context of reliable behavior. The file tells a story, and the story at level 4 is better than the story at level 2, not because you lied, but because you stayed that if you walked into a branch and said you were considering moving your accounts to another lender, someone would likely make an attempt to retain you. That is a different experience from the automated indifference of level 2. It is not a friendship, but it is the beginning of leverage. Level 5. High savings and assets. Your combined assets sit above $200,000. Superannuation that is ahead of your age cohort's median. An investment portfolio. A home loan with an offset account that is being used properly. You are not wealthy by the standard of what comes later in this conversation, but you are in the top tier of what most retail bank branches see on a daily basis, and the treatment begins to reflect that. The phone experience is different. Priority queuing is real. Hold times are shorter. The person who picks up is more senior and has more discretion to waive fees, to approve exceptions, to resolve problems in a single call rather than escalating to a team you'll hear back from in 3 to 5 business days. The better institutions, a dedicated relationship manager is assigned. Not always, but at some. This is where named contact appears. Someone who knows your account, who emails directly, who calls when something relevant changes. It resembles a relationship, and in some ways it is, though the relationship exists within a commercial structure. They are attentive because part of their performance is measured on the retention of accounts at your level. That framing doesn't make the access less real. The superannuation picture matters now too. At level 5, your super balance is large enough to attract attention from the fund itself. The generic call center experience starts being replaced by access to in-fund advice, to financial planning appointments at no additional charge, to investment option guidance that is actually tailored rather than generic. You are, at this level, worth advising. Not because you changed. Because your balance crossed a threshold that changed how the system categorizes you. Pre-approved products start appearing. Home loan pre-qualification with competitive rates. Premium credit cards with actual rewards, airline points, lounge access, travel insurance that activates properly, rather than the 0.5% cashback the entry-level cards offered. The institution is beginning to compete for your future, not just your current balance. They are thinking about what your financial life will look like in 10 years, and they are pricing their current offerings to remain relevant to that future version of you. You are a preferred client now. Named. Known. Flagged in the system as someone worth protecting. Level 6. High net worth. The threshold varies by institution, but generally begins somewhere between $500,000 and $1 million in investable assets, excluding the family home. At this level, the bank stops being a place you visit and becomes a service that is made available to you. Wealth management is offered. This is the bundled version of financial planning, investment advisory, tax coordination guidance, and estate planning, wrapped into a single managed relationship. The quality varies significantly depending on both the institution and the specific advisor you're assigned. Some are genuinely exceptional. Some are expensive salespeople in good suits who have learned to ask the right questions. You learn quickly to tell the difference, because the difference is measured in thousands of dollars. The conversations change texture. You are no longer being sold products from a product menu. You are being consulted. Someone is asking about your goals, your timeline, your risk tolerance, your family structure, whether you have a trust, whether you should. The bank is trying to understand your complete financial picture, not out of altruism, but because a complete picture allows them to capture more of your financial activity under their umbrella. The motivation is commercial. The experience is personalized. Both things are true simultaneously. Loan approvals move faster. Documentation is lighter. When something goes wrong, a wire transfer that has stalled, a fraud alert that has frozen an account you need access to immediately, a complex transaction that requires coordinating across multiple accounts, the resolution happens in the same conversation.
No callbacks. No os que lasting queues.
Someone with actual authority handles it in real time because your account warrants that response. There is one more shift at this level that is easy to underestimate. The bank now has an interest in your super, not just your banking. At level 6, the conversations begin to include your superannuation balance, your investment structure, your insurance inside and outside super, your estate documents. The institution is trying to move from being your bank to being your financial home. They want every product you have to be under their umbrella. That ambition is commercial. But it also means, for the first time, that someone in an institution is looking at your complete financial picture in a single conversation. For most Australians, that has never happened before. You are an asset to the bank now. Not a customer. An asset. The internal language, the internal protocols, the internal treatment, these are different. The distance between this and level 2 is not better service. It is a different institution, operating inside the same building. Level 7. Very high net worth, above $3 to $5 million in assets, the bank begins offering things that are not on the public website. Products that require a conversation to access. Rates that aren't listed on any rate card. Investment structures that are only available to sophisticated or wholesale investors because they carry minimum commitment levels or complexity that most retail customers don't encounter. Your home loan rate at this level is lower than what anyone at level 3 would be offered. Not marginally lower. Meaningfully lower. Enough over a 30-year term to amount to hundreds of thousands of dollars in total difference. The bank competes aggressively for your mortgage not because of the margin on the loan itself, but because your relationship brings ancillary revenue across multiple products they would rather have consolidated with them than distributed elsewhere. Your advisor at this level is not a generalist. They are a specialist, more likely a team. One person handling portfolio strategy and equities. Another handling tax optimization and structuring. A third managing estate planning, trust structures, and intergenerational transfer. They coordinate. They meet with you in a room that looks different from the rooms at level 2. The chairs are better. The coffee is better. The stakes of the conversation are entirely different. You receive special treatment at this level. That phrase sounds simple. What it means is that the rules governing retail banking, the standard minimums, the waiting periods, the approval timelines, the fee structures, apply differently to your account. Not because the laws are different, because the bank's internal policies have discretion built in. And that discretion is exercised in favor of accounts that generate significant revenue. Every degree of legal flexibility available is used on your behalf, because retaining you is worth the application of that flexibility. Level 8. Ultra-wealthy, private banking in Australia is a different product from wealth management. In the same way, a private charter is a different product from business class. Both get you there. The experiences are not comparable. At this level, you do not have a banker. You have a private banker, a title that carries a specific meaning inside the institution. This person manages a small number of relationships, sometimes fewer than 15. Their entire professional focus is on those relationships. They know what you are building. They know what you are protecting. They know the foundation. They know the family structure. They have direct access to the decision makers inside the institution who can create arrangements that no standard product catalog would ever reflect. The pricing at this level is negotiated, not published. The interest rate on a loan is what both parties agree to, not what appears on any screen. The documentation required for a complex international transaction that would take a retail client 2 weeks to complete is handled internally in 48 hours, because the people processing it have been made aware of whose account it is. The system that, at level 1, was automated and indifferent and oriented entirely toward extraction is now human, attentive, and oriented entirely toward yes. You are not a client at this level. You are a relationship. The institution's relationship with you is a named line item in a private banker's performance review. Losing you would matter to people whose careers are built on not losing you. Somewhere between level 1 and level 8, the bank stopped being a place you use and became a place that competes to serve you. That is not a small difference. That is the entire system, revealed.